Good morning, everyone. Welcome and thank you for joining our webinar today. This is Jyoti here, and we are happy to have you with us today here. Before we start the webinar, I would like to take this opportunity to introduce you to My Time Equity and Sudhir Pai. As an actively managed portfolio management and RIA firm, My Time Equity takes pride in being your dedicated partner on this financial adventure. Sudhir Pai is a financial founding principal and serves as a fiduciary investment advisor representative for the firm. Before I hand over to Sudhir, I would like to take this opportunity to show you the disclosure slide that our attorneys mandate that we show prior to every webinar. And on the same slide, we have also added the QR code for you to scan and join our WhatsApp group and get the everyday latest updates on equity market and other funds. If you have any questions during the presentation, please feel free to take them on the Q&A box, and we will have them during the end of our session. If you need Sudhir's help, please write to wealth@mytimeequity.com or call us at 972-330-2771. Over to you, Sudhir.
Thanks, Jyoti, and very good morning to all those who have joined the call. So, what a great market it was. We touched the all-time high, and it has been a great week. S&P 500 gained almost 3.4%. Nasdaq was up 4.2%. We have seen technology having a breakout, and we think this will continue, provided there is no news that can disrupt this trend. Bitcoin was up by 3% and gold fell by 3%. So there has been some consolidation happening in gold. Very clearly, money is moving out of commodities such as gold and silver and copper, and they are getting into risk on equities and Bitcoin. And on the news front, US and China trade deal is hopefully now fully official. The White House said the deal has been signed, and that's a very good news for the market, and we saw the impact of that in the last week. And the not so good news about the tariff on the tariff front is the negotiations with the Canada. There is a discussion about Canada imposing a service tax on digital services, and that has kind of sent a very negative message to the White House, and there is some amount of friction there. So we have to see how that goes. But one thing to keep in mind is a lot of input materials come from Canada, and this may have an impact on the inflation of the country in the next few quarters. And because of that, the Fed has always been taking a stance that the interest rate cut is going to be slow. They want to see the numbers hit the Fed's target for both inflation and unemployment. So when Jerome Powell testified in front of the Senate, he repeated the same thing, but he also said that there would be 2 cuts by end of 2025. So in my opinion, I think there will be more cuts in 2026, and if numbers continue to slide, in Q3 of this year, on the inflation front, we may see further cuts also. I was reading a post yesterday, and it was predicting an interest rate of anywhere between 2.5 to 2.7 by end of 2026. So if that happens, I think we will see a very good market for real estate, as well as small caps and mid caps. But right now, money is all flowing into large caps. Small caps have started kind of picking up over the last 12 days. We have to see if that rally continues, but my request and suggestion, as well as for our models, we are heavy on large cap right now. So the S&P 500 hit an all-time high, and with all the optimism that's going on, we think a minor pullback next week. Next week is a short week because of the Labor Day weekend. So I think there will be a little bit of pullback, which is very constructive if that happens, because markets going up and down is constructive rather than it's simply going up. So that's what has happened last week, folks, and next week hopefully should be a continued rally for the entire week taken into consideration, and let's see how it goes. Next slide. Okay, so the theme of today, the topic of today is FOMO versus fundamentals. Is this all-time high FOMO, fear of missing out, people just throwing in money, or is it fundamentally strong? Should we be worried? Should we get into the market right now? Should we continue to staying in the market right now? All of these questions keep bothering all of us. And here is some data which will help you know that the market is very strong. The fundamentals of the S&P 500 companies, the large cap companies, is extremely strong. So if you see the chart on the left hand side, the Q1 S&P 500 earnings increased by 13% year on year, which is extremely good. Because if the 500 top companies of the country is growing by about 13%, that should send you a message that the country's strongest companies are doing very well. So the foundation is strong. And for 2025 and 26, the expectations for future growth is between 9 and 13%. So the future is also strong. There is a little bit of concern about inflation, about job losses. While all that might come true, but fundamentally, if the companies are strong, we see all the airports kind of full, not too many layoffs happening. All that is good news, which should give us the confidence that this market is not in an artificial uptrend. And the correction that we saw during the Liberation Day is a very good indication that if the market falls almost 20%, enters into the bear market, it comes back so quickly, and that is because there is so much of money sitting on the sidelines, and I will explain that in the next slide. But if you look at the year to date return of different sectors of S&P 500, S&P 500 has 11 sectors. So if you look at multiple sectors of S&P 500, we see that there is a lot of potential on the for the technology stocks, because if you look at the data, out of the max 7 companies, almost 5 of the companies are not up for this year. There is still a lot of room for it to go to the all-time high of last year. We saw very good increases happening to Meta and AMD and Nvidia, but a lot of other companies of the S&P 500 technology sector are yet to kind of take off. So we think there is more here, more room for the index to kind of go to the next level. So we are targeting about 6400, 6500 very soon, maybe in the next 3-4 months. And then if you look at the sector which is financials and industrials and technology, which are marked here on this slide, they all have very good forward earnings estimate. And particularly technology valuation has been a little cheaper because of all the correction that we saw at the Liberation Day time. Next slide. Next slide. Okay. So what does the technicals tell us? If you look at the data for the past many years, starting 1988, you will see that when the months of May and June are higher or positive, the rest of the year does very well. And particularly the month of July, the first 15 days are very strong weeks. In July, the second part is not so great, but if you look at the entire month of July, is a very good month for many years. And this chart shows you that the returns can be anywhere on an average between 1.9 to 2%. And the returns that we have seen from the historical data for the next 12 months and next 6 months, meaning for the rest of 2025, we may be able to see an average of about 9% pickup in the returns, and for the next 1 year approximately 14 to 15% if you go by seasonality. So What does this mean? This means, there is every reason to be positive. There is every reason to be bullish about this market, even though we have seen a huge V-shaped recovery with the 20% fall and the market coming back like a beast. So if you are worried that this market may tank again, there is real no reason based on fundamentals and technicals and seasonality for it to kind of uh, go down. But anything can happen. Nobody has a crystal ball. Anything can happen in this market. Again, this is a very news driven market, and the news is what we need to watch. And if you're a trader, you have to be very watchful. If you're a long term investor, you don't really have to worry about this market. But if there is a change to the basics of US, if there is a change to the basics of trade, that can impact the numbers of these companies in the long run. And that is where this whole drop during the Liberation Day was all about. And I'll explain that in the next slide. But one request to all of you: if you have not joined our WhatsApp group, we have the QR code on every slide. Please join the WhatsApp group, because we post our daily updates about stocks, crypto, and commodities, and also share information about our structured notes and other opportunities in that group. It's admin only group, so you will not see a lot of messages there. It will be only messages from me and my team that you will see it posted, and it will not be more than like 1 or 2 a day. Next slide. Okay, so I talked to you about what is happening to US versus what is happening in the rest of the world, because we are like, oh, US market is at a all-time high. It went down 20%, suddenly come back up so high. Is this FOMO? Are people like just throwing money in this market without thinking? So here is my 2 cents to that, right? Market is very smart. Price action is everything. If the market is saying that we are at this percentage of return for this year, that means it's set. You don't have to worry about anything. Market will tell the truth. So if you look at the image on the left hand side, lot of money flowed into Europe and emerging countries over the last many months. And if you look at the last line, US actually is in red. Lot of money left US and went to Europe, went to emerging countries, banks, treasuries, dollars, cash. But if you see the different sectors of the S&P 500, industrials, technicals, overall equities, UK, bonds, the reduction of cash out of all these areas went to Europe and emerging market and banks. That means money is sitting in European countries' equities, and that is the reason you see the international model on our portfolio has done extremely well. It's close to 15% return for the year, I guess, our entire model. But if you look at individually every country like Germany, Europe, Indonesia, India, Japan, Thailand, all of these countries have done much better than S&P 500. And why is that? That is because when the Liberation Day happened, there was a feeling that US is changing. The entire foundation of trade that US has, where there is no tax on imports, everything is openly available in the US, anything can come from any country, it's all easy. And now suddenly everything changed, right? There is tax on imports, every country has to shell out money. So this change has projected that other countries are also going to grow because of this protectionist stance of the US. Okay, and that is true, because when a country like US starts charging a tax to other countries, that is when other countries will start thinking, oh, let us produce, let us use it for internal consumption, let's charge tax on others, all of that. So that means other countries will also pick up. You will see a lot of growth happening in other countries like India, including China, because there is a lot of things happening in China, and Chinese stocks are have lost almost 70%. So anything happening to those stocks are only good. Even if you see 100% growth, it's still not recovered from its 2019 downside that it saw, right? So what does this mean? This means there is a lot of potential for this money to come back from other sectors, other countries to the US. As we see, the tax cuts, happen, as we see companies giving better results, as we see the AI and blockchain technologies taking off, more innovation happening, there is a potential for more money coming in the US. And when the money comes into US, where does it go? It goes into large cap, mid cap, small cap, and crypto. That is where the money is going to flow, guys. And if you look at the chart on the right hand side, what does this show? This basically shows that the institutions are investing in technology. If you look at 2008 to 2025, the bar of 2025 is at the highest level. So more money is flowing into technology, and that is why you have seen this huge growth in the last 10 days in technology, particularly Nasdaq. So we are hopeful that more money is going to flow in these areas because the returns for earnings were good, profits were good, revenue was good, and with the news coming true of the BBB, the big beautiful bill, the tax cuts, I think that is going to be a huge catalyst for these companies to even show better numbers, and we are going to see a huge return between now and September. But again, as I said, these are all historical numbers, these are all data based thinking, so let's see how it goes. Time will tell whether what we are talking about is happening or not. So this slide gives you the information about what's happening next week. Next week is a short week because of the Labor Day weekend. July 4th, it's a holiday for the market. Sorry, it's Independence Day, not Labor Day. I'm sorry. So it's Independence Day, and that is the before that date, or on that date, or we expect the big beautiful bill, the tax cut and reduction act, to be renewed. So next week we have Fed Chair Powell speak again. I'm sure he's not going to say anything new. We are going to see the manufacturing index numbers coming out, and then the job opening numbers. So there is a lot of information that will be released next week. But given that it's a short week, we believe that it's going to be not such a big week. But I think Monday is going to be a little bit of a sideway movement, and after that we should see pickup in numbers. And next week, which is the week of July 6th, could be a very big week, if the tax cuts gets passed, and if Powell hints further rate cuts, and if the deal with India, deal with Canada, deal with other countries on the tariff end is signed off. All of that should really give a boost to the market, and that is in line with the seasonality, because I said July first week and second week historically are strong weeks. So if you look at it, seasonality repeats. That is because stock market is all about human mentality. Humans think the same whether it is 1980 or now. It's all about fear and greed. So I am very hopeful of next 2 weeks. Let's see how it goes. Next slide. By the way, next week we may not be having our weekly webinar. Next Saturday I'll be in Europe attending a conference, and after that I'm heading to India. So I'll do my next webinar not the next Saturday, but the week after that. But we will be posting our daily messages every day on the stock market, and you can access that through the WhatsApp group. Our portfolios did extremely well last week. S&P 500, as I said, was up 3.43%. And our growth model, if you just look at our only growth model, growth stocks, we were up 4.73%. For the year, the model is up 12.24%, 11.24% versus S&P's 5.51%. The next generation model, which is the innovative model, has done extremely well. And the high beta model, our all-weather model, which is the individual stock model, all-weather is representation of many stocks, and that we compare it to S&P 500 because it's a all equities but relatively lower risk compared to AI tech, high beta models. So you have see these models, doing about 3% more, 2.5% more than S&P 500. Our custom models, which are our capital protection actively managed models, where we try to get out of the market when we feel that markets are going to go down drastically, and that's what happened during the April 4th Liberation Day time. That's the time when we got in. Little later, after we got out, one day after the announcement of Liberation Day, so we missed some gain. But even after missing gains for almost 2 to 4 days, we are not very far from S&P 500. If you look at the margin model, we are 4.55% versus S&P is 5.51. So very soon we'll be catching that up. And these models are heavily into growth, Bitcoin, gold, defense, and international and small and mid caps. So it's a combination of different sectors, different assets, different geographies. Very well diversified model. And this is good for those who really want to protect their capital, who are not greedy for generating S&P level return, but we try to get that level of return. But in a news driven market where, if something is messaged and the market takes 4% downslide, we have to protect capital. But otherwise, this is like a big menu of models. If you choose to pick any one model and invest in it, we will not mind. But if you give money to us and say, hey, Sudhir, you manage our money, our goal is not to lose capital. Our goal, we are happy with if you are able to match the S&P 500 or get 1 or 2% more, but we will not be greedy there. But actively manage it, watch it every day, and give us the fiduciary, eyes to our money, and that is what we do in custom models. Next slide. Structured notes. So we have a beautiful note which I launched for myself. This is a note on Meta and Coin. I love Coinbase. There is a lot of good things happening about Coinbase. The Genius Act got passed, Stable Coin Act got passed, and so much happening in the crypto world. Today, the Fannie Mae and Freddie Mac, the lending companies, they take Bitcoin as a collateral if you're trying to buy your first time home. So they consider it as part of your balance sheet. Earlier, they were not being considered. So those who held a lot of Bitcoin, that asset was not considered an asset, but the law got changed to include that, in your collateral statement. So given that Coinbase is a pioneer, it's the only company which is US listed custodian in the US, and strongest company, that they are the custodians for all the crypto ETFs out there in the market. And Meta, Facebook, we all know, is one of the best companies in the AI space, in the social media space. So these are the two companies I chose, and it's a 3-year note. So basically what I'm doing here is I'm not getting any income, I'm not getting any annual payment, but the way this works is it's a 3-year note. At the end of 3 years, if both the stocks are up, you see which one is higher and you go with the lower one. Let's say Meta is up 100% in 3 years and Coinbase is up 200%. You will get 100% multiplied by 2.95. You will get 295% return. And the reason I chose Meta and Coin is because in these kind of notes you have to choose two tickers. You can't just take Coin and try to get 2x or 3x on your money. So we have to take two tickers. That is the bank's rule. And we selected a lot of companies. We looked at Palantir, we looked at Nvidia, we looked at other companies, but Meta and Coin gave me the best percentage return in terms of growth at the end of 3 years. And these notes are very liquid, so in case you want to get out of it, you can get out of it anytime, but you will not get the full 2.95%. So if both the stocks are up, let's say 10%, you may be able to get 8% return. So there will be a discount to the market price if you are trying to exit early, but it is liquid, so you don't have to worry about illiquidity in this. And the downside protection at the end of 3rd year, what if both the stocks are down or one stock is down, because we go with the lower of stock. If one stock is down, then you are not getting any upside. You are going to get downside only. Now, first 50% downside is protected, meaning you don't lose money. What would have happened is you are getting your money back, not any returns. But if it goes below 50%, that's when you lose money. Let's say Meta is down 60% in 3 years, then you end up getting only 40%. So I am a strong believer that technology is in the forefront. Institutions are throwing money at technology. More technology is coming because of all this, new innovative stuff. And the blockchain is in the forefront. Crypto is getting a lot of importance from the current administration. So with all that, I feel very comfortable with this note. It's $25,000 minimum, and we custody it in Charles Schwab. So if you're interested, please let us know. We don't have a lot of availability in this note. It's a limited availability note. So if you are sending us a mail and if we say that it's not available, please don't get upset with it, because bank has clearly said we can close this note anytime. Because when the market is going up, banks can always say, hey, look, you asked for this much and we give you this much. If you want more than that, unfortunately we can't give you more. So right now we have committed for 500k towards this note. We already have commitment of almost 400k. I think we have just about 100k left. So if you're interested, let us know, and we can add you to the commitment list. Next slide. Okay, so this is an income note. We showed this last week. This income note generates income of 28% if it is Nvidia, Intel, and Tesla, and the only income note currently available for trade. So there is a highlighted note at the bottom of the slide. So looks like we have only the last one out of the three. So we have just the Nvidia, Tesla, and Palantir note. The other two notes are filled. So the way this note works is, we are betting on these three stocks: Nvidia, Palantir, and Tesla. So it is a 30% income per year, and it's paid on a monthly basis, which is 2.5%. And you keep getting paid this amount in your Schwab account as long as all the three stocks or one of the three stock has not gone below 40%. So as long as it is not gone below 40%, you keep getting money. And there is something called as a memory feature included in this note, which means if in any 1 month, let's say if Tesla falls 50%, that month you will miss the payment. But 1 month later, if Tesla comes back up, you get paid for the previous month also. So this is an income note, very high yield, extremely good companies, but very volatile stocks. So again, 30% is a very high rate of interest when treasury is at 4.5. And these notes can be called after 3 months by the bank. The bank has the authority to return the money back to you at the end of three months. But the bank, when it returns the money, they have to return the full amount. There is no way they can hold anything, and they should have paid you all the months of interest, all the interest that is outstanding. So that is how this works. So do let us know. The trade date on this is not too far, so reach out to us if you're interested. Third note is a snowball note. When I say snowball, what happens here is the returns keep getting snowballed year on year. So first year the return is 30, first year it's 35, second year it's 70, third year it's 105. So the stocks here are Meta, Google, and Nvidia. If the stocks are all flat or positive at the end of year one, you get 35% return and your money is returned. If it is not, it goes to year two and you get your money back with 70% return, or it goes to year three and you get one. So it is one or the other. It's not that all three will happen. If first year you get your 35% in principal back, that's it. Money is back in your bank account and we are allowed to now decide on the next investment. So this is a 3-year note. The reason why we have 3-year notes are because we want the protection, because market is at all-time high. But you never know whether this is really the all-time high or whether it is going to go to the next level. We have been thinking market is all-time high from last 3 years, right? But whenever the market falls, there is the dip that gets bought because there is so much of money sitting on the sideline, close to $11 trillion sitting on the sideline. So money is only coming back in the market. Those who are sitting on the sidelines will come back and market keeps going up. So with that, I don't see a real reason for the market to go down, but anything can happen. That is why we take a 3-year view of the market. Okay, and these stocks, these notes are very liquid, as I said. It's not like investing in some illiquid venture fund or a crypto fund, real estate fund. These are very liquid structured notes. You can exit out of it in 2 days notice. Next. Okay, so this note is with Apple, Microsoft, and Nvidia. Again, the 3 solid companies, S&P 500. This note is expiring on June 30th. So you have only very less time. Monday is 30th. So I don't know if you can really execute this if money is not there in your Schwab account. So here the chance is you get 35% return at the end of year 1 if they are all positive, or it goes to year 3 and you get 3x of the lowest performing stock. Again, like the Meta and Coin note, but here there is a call option at the end of year 1, because our goal is to see how to make at least 30%. If S&P has generated 20+% last year, and if we can do 35% by investing in these notes, even if the market is flat from the time we bought, that's a pretty good investment. And liquidity is there, and this is long-term capital gain. You pay 20% tax on this. So reach out to us again if you are interested in this. Next slide. Okay, so this is something that we are showing for the first time. Private equity, if you have not heard about private equity, because private equity funds were only available to the ultra high net worth qualified clients, which means those who have net worth of 2.2 to $5 million in the past. But now, you have very high quality private equity funds and very liquid. You can exit out of these any day by giving 3 months notice. And you get these, each one of these funds will have about 5% of the fund value available for redemptions. So if you apply for redemption, your money will be sent if it's within that 5% of the fund rule. So there are 5 columns in this flyer. Private equity means it's a fund that invests in cash flowing companies, and they keep leveraging buying more companies, and they generate a very non-correlated, meaning it's not volatile like the stock market, and they give you a return which is better than S&P 500's return. So if you look at these columns, you will see the names of the funds. We have Carlyle. Carlyle is a it's a $85 billion fund, and Kohler, which is another large company, it's a $590 million fund. Stepstone, $4.9 million fund. Vista One, $100 billion fund, and then EQT, it's a $178 billion. So these are in different sectors. If you look at Carlyle, they are in IT, healthcare, and industrials. If you look at EQT, they are in healthcare, technology, and services. The minimums for these are not very, very high like in the olden days. The minimums for this is anywhere between 25 and 50K. And there are also 10K in case of EQT. We buy this inside of your Schwab account. So, some of these are only for qualified clients, qualified purchasers, but there are 2 options for accredited investors and 1 for retail investors. Stepstone, if you see, anybody can invest in it. There is no real need for accreditation or qualified clients. And if you look at the returns, the last line, the returns of these funds are anywhere between 12% to 19%, 22%. So extremely good return, not up and down like equity markets. Track records of all these companies are solid. Minimums are minimum, and different asset classes, different sectors, different industries. So if you're coming to me with $1 million of money and you say I want to diversify, I don't like the ups and downs of the market. That is when we talk to you about structured notes, because it doesn't go up and down so much, right? You are insulated because there is a 40%, 50% protection on the downside. Here, these are not liquid stocks, meaning they are not IPO stocks. This is not a ball that people play with. It is a private fund, but as large as a public ticker, 95, $100 billion. They're all huge. So if you invest in this, you get a good return. You can exit anytime, and these are very, very stable investments. So if you are interested in private equity, which you may not have heard of ever in your life, and not at all of these companies which are like billion-dollar, trillion-dollar companies. So talk to us. We can go over each line item, thoroughly with you. Each one of them represents, a different asset class. If you look at EQT, for example, EQT has invested in about 3 Indian companies in healthcare, which are very ripe for going to an IPO. So this is where we have found this. We want access to India, we want access to healthcare in India, technology in India, which is going to give us highest return. But if you look at the targeted returns, why are they between 12 and 22? Because they are the past performance and conservative estimates of these funds. But private equity typically generates anywhere from 15 to 33%, depending on their investments and depending on the timing. But the chances of losing money in this versus a venture fund is much lower, right? Because there is leverage in these funds, meaning they take some loan to generate higher returns. But at the same time, these are not startups. These are very high quality cash flowing companies, which doesn't want to go public, because going public means too much of rules, regulations, and filings, and volatility goes up and down. Whereas these are very stable. The high net worth individuals, the family offices, the sovereign funds, they like such funds. And that is what we are offering you here: institutional class investment in alternative investments. Next slide. Okay, so tax planning season is here. After April 15th, we start talking to our clients about reducing taxes for 2025. So this is a gas station deal. You can own this property fully if you want to, or if you want to join with a couple of your friends, you can invest in this together. These are very good, high quality gas station deals from Quick Trip. Quick Trip is a very, very, very seasoned gas station brand. The lease that we have from Quick Trip on these properties in Missouri and Georgia is almost 9 years. Occupancy is 100%. And the cash on cash return that you will get from these gas stations is anywhere from 4 to 5% to 6% per year. And then when you sell it, you will make a return on the growth side. The best part about gas stations are you get a lot of land and you get a small building, and that building can be completely written off. So the rule of thumb here is, if the tax bill gets passed in a couple of days, if you are paying $5.3 million for this property, you can almost write off 90% of this property in year one. Okay, you see 40% in year one in this flyer because the tax bill is yet to be passed. So if the tax bill does not pass, these are the economics. If the tax bill passes, all of these returns is going to go over the roof, right? So it's a good idea to invest in a gas station property which gives you the returns like a treasury yield, like 5%, 6%, 4%, like that. But it gives you a huge write-off. Your investment cannot be written off. You're investing in stocks, or if you're investing in bonds, or if you're investing in structured notes, right? Whereas investment in real estate will give you the write-off. It's a good investment for those who have a lot of income in 2025. And when it comes to management of purchase, management of the property, selling of the property, all of that will be managed by us. So we are buying almost 12 of such gas stations all over the US. And this is only for our very high net worth clients. This is not going to be a $25,000 investment. If you want to invest $25,000, we have the gas station fund. You can always invest in that. But this is an opportunity for you to invest in a property that you may own for next few years and decide to sell whenever you want. It gives you control, and it gives you a lot of upside and full depreciation, because this is your property and you have no headache because we manage it. So again, it's a big check thing. Small checks, we have the fund. For anybody who can write a big check, we can buy these properties for you. Next slide. Okay, I think we are almost at the end. So we will take questions now. There is one question that I see here. Do you have any funds investing in private companies like Neuralink or SpaceX? Yes, we have a private fund. The fund has invested not only in SpaceX and Neuralink, it is also in OpenAI. It has Lambda Labs. It has got Perplexity and other big names. We can send you the details. We had posted the information on our WhatsApp group. The minimum to invest is $10,000, and it's a very liquid fund. If you invest in it, you are entering it today's price. Let's say today, SpaceX is valued at $350 billion. So you enter at today's price. You are not paying any profit sharing, any fee to anyone. It is a fund like the private equity fund that we showed you, but this is a pre-IPO fund. Jyoti, if you have that in the slide deck, you can bring up, that would be great, but otherwise it's okay. The pre-IPO fund which we had shown in the past. So this is that fund, is very liquid too. You can exit out of it anytime, because the way this public fund with all these private companies work is 80% of the money is in these private stocks and 20% of the money is in public stocks. So when you need money, they will sell the public portion of it and return the money back to you. So it is not, there is no situation where you are stuck with the investment, because a lot of my clients who invested in SpaceX since 2021, including myself, we invested it the first time when SpaceX was $75 billion. Today it is 350. So our money has gone up 5x, but the point is it's not liquid, whereas here you will get liquidity also. What is the investment in gas stations? So if you're looking for investment in a fund, the minimum is $25,000. If you want to buy a complete gas station, again, don't worry about management, because that's our job. We have a full-fledged team to manage, buy, manage, and sell. So the minimums there are anywhere between the value of the asset is anywhere between $3 million to $12 million. 70% comes from the bank and 30% comes from you. So if you are interested in any one of those, do let us know and we can discuss in detail. Which private equity fund do you recommend? MT has now close to 10 different private equity funds. Are there any tax benefits like Aries in this private equity? Unfortunately, there is no tax benefit in private equity fund, because these are companies that they buy. Now there are some tax benefits like QSBS election and things like that, which all happens inside of the fund and you see the net returns. But unlike a real estate fund like Aries, we don't have a benefit of depreciation and not having to pay tax. The growth of a private equity fund, if there is returns, you will only, if there is realized growth, you pay tax, otherwise you're not. But when you get out of the private equity fund, you have to pay tax on the difference between the purchase price and the sale price. So we have multiple funds. Now, which private equity fund do we recommend? It depends on the risk profile and the overall exposure to different industry class and all that. So if you're looking for healthcare access and if you're looking for India access, then EQT Partners is a better company. If you're looking for US exposure, European exposure, then we have Carlyle. If you're looking for GP-led, LP-led type, stuff, then we are looking at, something like Kohler. So yeah, we can again get on a call and explain in detail. We have our account managers on the standby. We can send you the reading material for it, and we can talk to you in greater detail about that. Very informative seminar. Is there commission charged at the end of term 3 on growth notes? So we don't charge any commission. So none of our products here that we are showing you are commission products, except when we do a life insurance plan or an annuity plan. There is a commission that gets paid to us by the insurance company or the annuity company. But whatever you saw today, like the structured notes or managing money through our equity models or buying properties for you, there is no commission. We charge a fee. Our fee depends on the money being managed. If your money being managed in the Charles Schwab account is less than $1 million, we charge between 2 and 1%. If it's more than $1 million, it is 1%. So very simple formula, and we can discuss with you if you want to go slow and then ramp up and things like that, because we are trying to grow the business, help the clients, with the right strategy, right product. that makes sense for you. Is there commission charge only? So yeah, there is no commission. We are not broker dealers right now to charge commission. So I have two questions here. In the gas station fund, if I invest 40K, my returns would be with 5% of 40K. In a direct gas station, if you are going with a 60% loan, now 40K investment would return 5% on 100K. I'm looking is in the right direction. Slightly long question, but if you are investing, let's say 40K in the gas station fund, you will get anywhere between 3 to 5% return. That's what the fund has been delivering. But if you buy your own, let's say it's $1 million property and you have to put 300K down. So on that 300K, you will be making about 6%, because on your money you are making around 6%, because that's what you learn from the rental income of this gas station. So the cap rates that we typically buy is around 6 and 6.5. That means your return on your money is going to be around 6.6 to 6.5, and the return you will make on the bank's money is the difference between that and the bank interest rate. So again, all of this we always try to maximize it for you and get you the best deal out there, because our interest is in your interest, and we are just providing you a solution here, which is what we do, provide investment as a solution service. Do you manage the previous employer 401k plans? If so, what is the process? Yes, we do manage previous employers 401k plans. Well, it is not a very complicated thing. What we typically do, previous employers 401k plan, we move it to a traditional IRA, and to Schwab or to Interactive Brokers or one of these two custodians, and we buy securities in it based on the discussion that we two have. And what is the process? It's a simple process. We have to roll it over into an IRA. We also manage current employer 401k plan if your current employer allows for it, and if they have access to BrokerLink. BrokerLink is the process and the software through which we can enter into your 401k plan and manage it. We do that as well for many clients. So that's the process. It's pretty simple, and the fee that we charge is the same. If it is first 250K, we charge 2%, and if it is more than $1 million, we charge 1%. So that's our fee. And when you look at what we do, the fees really gets paid very quickly, because the access of stuff that we are giving to you here, let's look at the income note. If you're getting a 2.5% income per month, our fee is actually nothing. We also have a fee structure which is based on profit sharing. Then in that situation, we charge 0.5% and we take 20% of the profits. So we are very happy if you want to opt for it, because we end up making more money. But typically we tell this to the client that, look, we don't want to charge you more by making it more like a profit sharing, because it doesn't make sense. The structured notes are doing very well, and we don't want our clients to feel bad when they make the payment to us and they feel that, hey, why did I make the mistake of choosing the second option, right? So we are being very upfront and saying, hey, look, maybe you should not. So does the private equity funds have any maintenance fees? Where is the fund held? Will be getting any security against this investment like NYSE? So great question. These private funds are funds which has its own fees. Like for example, if you look at Carlyle, their fund is a fund that makes money by offering these funds, right? Now we make money by bringing the right fund to you. That is what our fee is for, to manage your overall assets, not just get you in one fund. So the typical fund fees, that these funds charge, and all the returns that I showed you are net of fees. So the fund fees typically is anywhere between 0.5% per year, like an ETF, to 1 to 1.5% per year. So that is how typically the private equity funds of this size charge fees. And where is the fund held? So everything that we showed you here, we do it inside of your Charles Schwab account. So first is we have to open a Charles Schwab brokerage account. Once we do that, we can buy the structured notes under that. We can buy any of these funds, any of these ideas that we are showing you, manage your portfolio through different stocks, bonds. ETF models, and our fee is the same, whether you do Carlyle or whether you do structured note or whether you do put money in stocks, our fee is the same. It's on the account balance of the Charles Schwab account is what we charge. Can we share these slides? Yes, we post the recording of this session in our WhatsApp group, and we also send an email later. If please join the WhatsApp group, because everything comes there automatically anyways. So you can always go back and look at it. Is there a program where you have where you deliver a certain percentage no matter what you do with the funds, or where you invest them? Well, there is no one program that we have designed, because it doesn't make sense for me to create a 10% program and make money by putting it in the 40% program, because when you put it in a 40% program, there is a lot of risk that we take, and we don't want to take risk with your money and only pay you 40. Rather, we will pay you whatever the fund makes, just charge you a small fee for doing what we have to do. That is called as the fiduciary responsibility, and that's what we are doing here, right? So, but what is right for you is something that we have to figure out. We have to talk to you, spend time, understand what your goals are, and based on that we have to invest and monitor it every quarter. That's what we do. So it's a very intense long-term relationship that we are trying to build here, not just giving you one item and then saying, hey, now you are on yourself. What is the underlying business of structured node? How is the how can they yield so much returns? So everything depends on volatility. If you look at some of the structured nodes with Tesla, Palantir, the returns are higher because these are strong companies. The growth is very high, volatility is high, meaning like Coinbase, take Coinbase, it went up 7% day before yesterday, it fell 6% yesterday. So the swings are very high. When the company is fundamentally strong, they are S&P 500 companies, volume is very up, and the options are traded at a very healthy margin. That's when they are able to generate this kind of returns. So there is no rocket science here, and we work with the bank because the banks are much smarter. They have a much bigger, trading desk, and we rely on them, to create a structure that we want, rather than trying to build a structure for you inside of your account through options. It can get very complicated. And also we have a lot of clients who just want to put X amount of money and have the predictability. They don't want to get confused by seeing 15 option item, 15 calls and puts in their account. This will show you only one line item in the Schwab account saying, structured note, meta and coin, and $50,000. It's as simple as that. So I have a Schwab account. Do I need to open a new one? So you don't have to open a new one, but your Schwab account, if we have to manage, you will lose access to trade in it. So if you would like to trade in your Schwab account and us to buy stuff, that can't happen. So either you have to be trading in your account or we have to be trading in account, because the law says that when we manage a certain account, we own the responsibility of that account. We have the fiduciary liability. Our insurance covers that. So if we screw up, we have the insurance protection for that, right? We can't have that protection if you are also trading inside that. But what we can do is open a new account, or you can give us access to your account fully and not trade, but you can always tell us if you want us to place any trade, and we can do that. But you will have to send it via email and confirm to us to place the trade, because then we are acting on your advice. Next question is, since the gains are tax free, I would like to use my Roth IRA account to capture volatility in the market. Would you accomplish such risk appetite? Yeah, of course. I am a CPA. My last 20 years has been more of and doing tax planning, tax filing, CFO work. So tax comes first for me all the time. So I will do everything that saves you tax. The reason why we have growth notes, we have snowball notes, is because you save 17% tax straight off, right? Whereas income notes, you pay regular income taxes. So very happy to plan your investment in a very tax-free environment. So shoot an email to wealth@mytimeequity.com, and let's set up a time and talk, and then help you with your desire for your money, and give you the right protection and the growth it needs. Folks, that was the last question. We are at 11:55 Central. Thank you very much for your time. And next Saturday we are not having the webinar. So I suggest You keep all your questions ready for us or send an email and we'll answer to them via email. But otherwise, have a great weekend, rest of the weekend, next week. Happy Independence Day. And if you're traveling, safe travels. And I will talk to you next time from India when I'm there. Thank you very much, folks, and have a great day. Bye-bye. Thank you, Jyoti.
Thank you. Bye-bye.